One Finance and Money Control present Personal Finance Unlocked. Download the One Finance app. Investments in the securities market are subject to market risks. Read all the related documents carefully before investing.
Hi, this is Amit Trivedi, co-founder of Asset Knowledge Private Limited. It's a firm that is engaged in improving the well-being of investors through investor education and skill enhancement in the intermediation space. Emergencies can strike at any point in time, and emergencies mean they are typically unplanned and unexpected. Now, as a protection against those emergencies, you need to have some financial corpus, and that corpus is often referred as the emergency fund. So, typically, an emergency fund should be built to cover a certain number of monthly expenses. And that can be done by saving something every month out of the regular income. Having said that, there is another way also. When you have a windfall, that windfall, some part of it can be used to set aside as contingency fund. A few things can happen, and as we all know, sometimes the emergencies or critical situations strike us uh, and take us totally by surprise and shock. Some of the things could be on account of medical contingencies or medical emergencies. There could be some natural calamities, and sometimes there could be some routine repair and maintenance work which happens much before one is planned. First of all, you start with emergency fund and insurance parallelly. What are the requirements as far as these calamities that we are talking about or the emergencies that we are talking about? For any family, when there are expenses to be met, there is generally a commensurate income. It is the income that may be at risk on account of four major things. It could be a death of the earning member, disease, or disability. On account of these three, there could be loss of income or reduction in income. The fourth risk is the loss of job or loss of employment or closing down of the business, because of which the income stops. The fourth one is where there is no insurance available against loss of job. But the first three, death, disease, and disability, there are insurance products available. So those should be considered first. Number two, emergency fund is something that, as we said earlier, the primary objective is easy liquidity, and objective number two is protection of capital or preservation of capital. And to that extent, the emergency fund should be invested in a manner where we don't really bother too much about the returns that we earn. Now, if that's the case, too much of contingency fund may bring down the overall portfolio return, and too little contingency fund may leave us exposed to some risks beyond what we can manage. And that's the balance that one has to strike. But while striking the balance, if the emergency fund becomes or emergency becomes bigger than the fund, in such a case, some other part of the portfolio can also be used in two ways. Number one is you can take loan against some of the assets. So there are loans available against one's house, there are loans available against the investment portfolio, and there are loans available against some types of insurance policies. So this loan could also be explored in the event of an emergency which is much beyond the fund that one has created. The second option is to sell some of the investments, liquidate those, and use that money for funding that emergency situation. First and foremost is to take a very close and critical look at one's cash flow. And by cash flow, I mean the income that the family is receiving and the expenses that the family is incurring on a regular basis. Extend the expenses further, there are some non recurring or irregular kind of expenses also. There are expenses where one can use discretion whether to spend or not, or whether to defer, and there are some mandatory where no discretion is possible. Then what we need to cover at the minimum is those mandatory or compulsory expenses multiplied by whatever multiple that we are thinking of, 3 months, 6 months, etc. Now, within that mandatory or compulsory expenses, it's important to consider the insurance premium also, because even when one is not earning or there is a loss of job temporarily, insurance premium cannot be stopped. That's a huge cover that one needs at various points in time. Once that fund is identified, now how do you build it and where do you keep it? The money can be kept at various places where even if the earning is low, the liquidity is instant. What are the options? Number one, some part of the money may be kept at home, the cash at home component. The second is the savings bank account, of course. Keep some money there. And at the third level, you can keep some money in the bank deposits, liquid mutual funds, or money market mutual funds. We hear a lot about building a long term portfolio. A lot of people keep talking about the benefit of compounding, and the power of compounding sets in over a period of time. However, in order to reap the benefits of that power of compounding, it is important that we stay invested for that long period. And in order to stay invested for that long period, short term needs have to be taken care of. Otherwise, if the short term needs are not taken care of, we are going to dip into the long term portfolio, which would mean we lose the benefit of compounding. And if that's the case, the immediate requirement is to start with keeping in mind the risks involved. Now, typically, the risks on the portfolio are inflation and volatility. In order to get protection against inflation, we invest in volatile assets. But in order to get protection against assets which are volatile, or we want to invest in assets which are not volatile, there we are exposed to the risk of inflation. Now, insurance is critical. Somebody not buying an insurance policy is unnecessarily exposing oneself. Spending money on the insurance premium, and then if the calamity doesn't happen, is not a bad decision. It is actually a wise decision because one has bought protection. Now, there are 3 or 4 different important insurance policies that one must consider. The first is on the health side, which is where health insurance and critical illness insurance would come in. Second is life insurance, which covers the financial loss to the family on account of death of the earning member. And third is once you bought various assets, including the house that one would have bought, the vehicles that one would have bought, the insurance on those assets. So there is a vehicle insurance available, there is a householder's policy available. These 3 types of insurance are important and required. Let's turn the question around and say, in which kind of situations The absence of insurance can create havoc. When the earning member of the family untimely dies, the family's expenses for their day-to-day living, the financial goals of family, even if I only look at the basic necessary financial goals like education of children, or maybe buying a house for their own, if the family is living in a company provided accommodation. No, these basic goals also cannot be met, because all these goals over a period of time would get funded through the future income that this person is supposed to be earning. And in such a case, not having life insurance is a problem. We started with the definition of emergency fund, which begins with the potential loss of income due to loss of job while the household expenses continue. The loss of job, even if it's on a temporary basis, could happen on account of some health conditions. Now, when there is a health condition, the person is hospitalized, so there is hospitalization expense and the income stops. And this risk is huge, especially for people who are self employed, who are professionals, because there is no salary coming, there is no income coming when you are not working. And in such a situation, health insurance gives that financial protection for that period. Though health insurance will only cover the expenses and not cover the income, the expense part also, it's important to get covered. Life insurance, as we discussed earlier, life insurance policy is actually not for the person in whose name the policy is taken, it is for the dependents of that person. And in the absence of that policy, again, their finances go out of order. And from that point of view, both life and health insurance, along with contingency fund, they form a good safety net for a family. The whole idea behind financial planning is to plan your finances in a manner that you can protect the downside, but at the same time you are ready to capture the upside as well. And for that purpose, multiple financial instruments are required. In order to capture the upside, you have an investment portfolio, and in order to protect the downside, there are, you know contingency funds and instruments like various insurance policies. Use a prudent combination of all. So, the subject of financial planning or management of personal finances, uh, as we just discussed, involves multiple aspects, but eventually it all is related to the life of a person or a family. How does one live a comfortable financial life? And for that purpose, a process of planning is required. And that process of planning involves having a group of experts collaborating together and helping the people take care of various aspects, whether it is downside protection or whether it is enhancement of upside. And for that purpose, firms like One Finance play a huge role by putting things together and offering a comprehensive solution.
One Finance and Money Control present Personal Finance Unlocked. Download the One Finance app. Investments in the securities market are subject to market risks. Read all the related documents carefully before investing.